Hey guys, it's Nick. The market had a nice bounce in the last week or so, but this week will decide if that bounce will continue or if it will head back lower. It's a very strange time in the market because investors are now hoping for a recession because they believe this will cause the Fed to not only stop raising interest rates after this Wednesday, but they think it will cause them to go back to lowering interest rates in 2023. This is, of course, what investors want so that they can make the stock market go back close to the old highs. So let's take a look at what is going on in the economy to see if we are already unofficially in the recession. So the US PMI, or Purchasing Managers Index, crashed into contraction into July. And analysts expected the flash US composite PMIs to increase modestly from 52.3 to 52.4. But the manufacturing July flash slipped to 52.3 from 52.7, and the services July flash crashed to 47 from 52.7. So in case you don't know what the PMI survey is, it's a survey of purchasing managers in all different industries in the country. And if the index is above 50, that means the economy is expanding. If the index is at 50, it means it is flat. But if the index goes below 50, that is that the economy is contracting, and that is the sign that we are going into a recession. Now, there's two PMIs. There's the PMI Manufacturing and PMI Services. And what do they mean by flash PMI? What that means is it's not the official report. They don't have all the respondents back yet. They have maybe 85 to 90%, but usually it's pretty accurate of where the number is going to come out to. So here's a chart of the PMI services and manufacturing, services in blue, manufacturing in green. They went below 50 during the pandemic. And now the services, at least on the flash report, is below 47. And the manufacturing index is very close to dropping below 50. And this red line is the City Economic Surprise Index, and this gauges economic surprises to the upside and to the downside, meaning earnings and other economic reports that come out. Do they come out better than expected or worse than expected? And so you see it started dropping below the zero line around July of last year. It dipped below to about minus 60, bounced up, but now it's back down to its lowest level since the pandemic. So the PMIs indicate that we are getting very close to or are already in a recession. What about the housing market? So this is the Case-Shiller Home Price Index, the national index, and the top 10 metros. And it starts in 1987 at an index of 100. And you see during the housing bubble, it went up to about 450 and dropped as low as about 150, at least for the Las Vegas index. But now it is as high as 800 in some of the metros. So when is that bubble going to pop? Well, possibly it's already popping. So Redfin reported the price reductions in the percentage of homes for sale in different metros that it tracks. This is the share of homes for sale with a price drop in June 2022. In Boise, 61% of the listed homes had a price drop in June. And so it goes down the list: Denver, Salt Lake, Sacramento. So here's an expanded list. Even Tampa, 44% of the homes listed had a price reduction. Phoenix, San Diego, even hot markets like Texas, 40% of the listings had a price reduction in June. Now, unemployment is a lagging indicator. Usually you are already in a recession before the unemployment rate starts ticking up. So here's possibly a canary in the coal mine. This article says about 45% of small U.S. businesses are freezing hiring amid soaring inflation and labor costs. So the more evidence we have of a slowing down or that we're heading into a recession, the more happy investors are with this news, because They believe the Fed will raise interest rates 3/4 of a point this Wednesday and then stop. And so not only do we have the Fed, but we have a lot of important earnings coming out, including Microsoft, Alphabet, Facebook, Apple, and Amazon. So if enough of these big companies have some disappointing earnings, that is just going to add fuel to the fire to the idea that the Fed is going to stop raising rates after this Wednesday. Matter of fact, here is a chart of rate change expectation in the first quarter of 2023. So just a few weeks ago, at the end of June, the expectation was that there would be a rate hike of 5 basis points in the first quarter of 2023. Now, just not even a month later, the market is expecting a 0.25% rate cut in the first quarter of 2023. And so with a recession comes demand destruction in energy. And so Biden says gas prices are declining at one of the fastest rates we have seen in over a decade. And this is a pretty funny edit. Somebody overlaid the United States recession probability median economic forecast, and it's just going up. And this is a fake chart of average retail gas prices. Look how steeply it's dropping. It looks like it's dropping 90%, right? And this is from June peak to July month to date 2022. So look how fast that gas prices are dropping thanks to Biden pumping out from the SPR and possibly from going into a recession, right? But let's look at the real numbers. So here are the real numbers. The US retail gas price was $1.88 back in May 2020. The peak that he shows on that chart is June 13th at about $5.10. And now we're at $4.60. So that chart represents a whopping 10% drop from the peak of $5.10 here to $4.60 here. Why does it look so steep? Because they don't start the chart at zero. They probably started it at like $4.60 here, and it goes up to $5.10 here. And so they kind of magnify that drop. Like they say, figures lie and liars figure. And so let's look at the charts of the S&P 500 and the QQQ's NASDAQ 100. This is the SPY on a monthly, weekly, and daily chart. The monthly is bouncing off the 50-month EMA, exponential moving average. The MACD, though, is at a peak and has crossed and is heading down. And this is kind of like a really big tanker ship. It takes a long time for it to turn around. And once it starts going in a direction, it goes for a pretty long time. Whereas the weekly chart is kind of in the middle, like a small yacht, and a daily chart is like a rowboat or something like that. The weekly chart looks like it has a temporary bottom here. It bottomed out and it's been having higher lows and higher highs, but it will probably stall out somewhere around here, 406 or 418. Before there's some kind of pullback, and similar thing kind of goes for the daily chart. The daily chart has gotten above the 50-day EMA, but looks like it may be losing some steam, or people are waiting to see what happens on Wednesday with Powell and what he says. The QQQs look similar to the SPY chart, at least on the monthly. The weekly and the daily actually looks a little bit stronger than the SPY because tech has been bouncing a little bit better. And so the daily chart is solidly above the 50-day exponential moving average. So for the rally to continue through the summer, people have to hear from the Fed that after this Wednesday, they're kind of done cutting rates for the rest of the year unless something crazy happens. I would expect that the Fed will raise rates by 3/4 of a point on Wednesday, but their wording will be something along the lines of, we promise to not raise rates again until inflation comes in higher than the last 9.1% CPI reading. So any CPI number that comes in lower than that will be proof that we are well on the way back to their targeted 2% yearly inflation. if you can believe that. Of course, this is just to calm the markets before the election. After the election, anything goes. Personally, I don't believe we're done with this bear market since we have not had a real capitulation yet. As always, it's your money, so make your own decisions. Thanks for watching, guys. I'll see you in the next one.